Imagine walking into a grocery store late at night, well after midnight. The store is nearly empty. A few employees are restocking shelves, and only a handful of customers are shopping. You pass by the clearance section and notice premium cuts of steak priced far below their usual level. Nothing is wrong with the product. The store simply wants to reduce inventory before the next day begins. You purchase the steak at a discount. By morning, when the store fills up again, the price has returned to normal. That same situation is unfolding in the silver market right now, just on a much larger scale. Understanding price versus value. One of the most important concepts in financial markets is the difference between price and value. Price reflects the most recent transaction. Value reflects long-term fundamentals. A price is shaped by who is trading, how many participants are active, and how much liquidity is available at that moment. Change any of those factors, and prices can move quickly, even if the underlying asset remains unchanged. This distinction is critical when analyzing recent moves in silver. Recent price action in context. Silver has pulled back from recent highs and is now trading lower than it was earlier in the month. At first glance, that move can look concerning. Many investors instinctively assume that a decline signals weakening demand or a breakdown in fundamentals. But when we examine the situation closely, the explanation is far more structural than economic. The impact of thin trading conditions. Markets do not operate the same way at all times. During certain periods, especially around major holidays, participation drops sharply. Large institutions reduce activity. Decision-makers step away, and overall volume declines. When fewer participants are present, prices become more sensitive. Smaller trades can have a larger impact, and price movement becomes less reliable as an indicator of true value. This environment makes short-term price swings more common and often more exaggerated. Temporary selling pressure. Modern markets rely heavily on automated systems and predefined risk controls. These systems are designed to manage exposure, but they can also amplify short-term movement when trading conditions are thin. When prices drift into common exit levels, selling can increase temporarily, even without any change in supply or demand. This type of pressure tends to be short-lived and structural rather than fundamental. Fundamentals remain stable. Looking beyond price movement, the underlying fundamentals of silver remain steady. On the supply side, production levels are stable. No major new sources have emerged. On the demand side, industrial usage continues. Silver remains a key input across multiple sectors. There has been no meaningful shift that would justify a long-term revaluation lower. Global market signals. Another important factor is how silver is priced internationally. In some overseas markets, silver continues to trade at notably higher levels than in U.S. markets. This divergence is unusual and provides valuable insight. Under normal conditions, price differences between regions are short-lived. Trading activity typically brings prices back into alignment. When that alignment doesn't occur, it suggests that logistical or regulatory factors are affecting the flow of material and capital. Why price gaps can persist. Bringing prices together across markets requires certainty that goods can move, that transactions can settle smoothly, and that capital can be transferred without friction. When uncertainty increases, those processes slow down. As a result, regional prices can remain disconnected for longer than usual. These situations often reveal where real demand exists and where price signals are being distorted by short-term conditions. What physical demand tells. U.S. higher prices in physical markets reflect real-world needs rather than short-term positioning. Industrial buyers are less focused on daily price changes and more focused on securing supply. For them, Availability matters more than temporary fluctuations. Over time, markets tend to realign with these realities, looking forward as normal participation returns and trading volume stabilizes. Price discovery improves. Temporary distortions caused by thin activity typically resolve. As more participants re-enter the market, markets have a long history of correcting short-term imbalances once conditions normalize. Key insight: short-term price movement is often driven by structure, timing, and participation. Long-term value is driven by supply, demand, and utility. Understanding the difference allows investors to interpret volatility with clarity rather than emotion. Conclusion: financial markets are shaped by human behavior and market mechanics. When participation drops, prices can temporarily drift away from underlying value. When participation returns, those gaps tend to close. What we're seeing in silver right now is not a signal of collapse. It is a reflection of temporary conditions. And those moments often provide the clearest insight into how markets truly work.